folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, let you know what's going on out there. The answer is not too terribly much. It's pretty quiet. S&P 500 right now at about 6070. That is up about 28% year to date. When we factor in dividends, up just over 30%. So the S&P 500 having a phenomenal year. Meanwhile, bonds effectively flat year to date, as measured by the Barclays Ag. On a price basis, up just the tiniest smidge of a little bit. When we factor in dividends or the interest payments on those bonds, they're up about 3.5% in terms of total return. And just to give you one last level, the 10-year Treasury is hanging out at right about 4.2%, which is pretty much exactly the same place as it was when we last talked. So the Treasury market, at least the longer end of the interest rate curve, hanging out, not really moving dramatically in one direction or another, which is all good to see. First off, we'll cover the news that matters. So we got a jobs report out on Friday of last week. Jobs growth in November rebounding sharply from October's number. October's number obviously impacted by the Boeing strike as well as some storms. We saw about 227,000 jobs added in November. And importantly, saw wage growth of about 4% year over year, which is actually quite good. Anytime that we see wage growth outstripping inflation, that generally means that people feel like they have a little bit more money in their pocket. That's supportive of consumer confidence, supportive of consumer spending. So a good thing to see there. And then we also saw the unemployment rate tick up ever so slightly from 4.1% to 4.2%. Once again, this is just, right around that 4% number, which is kind of your bright line test. Nothing to get too terribly worried about in the unemployment number. Some people in the marketplace saying that slightly higher unemployment number will give the Fed a little bit of confidence to reduce interest rates by another 0.25% when they meet later in December. And I got to tell you, I really think that that's going to be far more dependent on the read that we get on CPI or inflation that is scheduled for Wednesday of this week. That expectation there is for about 0.3% month over month. I think if we get a core reading that's somewhere between 0.2 and 0.3, that may give the Fed permission to go ahead and cut rates. We see anything higher than that, I think the Fed will likely be on pause. So an interesting data point coming up on Wednesday, which we will keep our eyes on. In the meantime, I will just mention some news that doesn't matter. And once again, this is that doesn't matter really too much to your portfolio. Not that the news doesn't matter, but we have some political turmoil going on in Korea as they attempt to sort out exactly who's going to run the country there. And then we also have some turmoil going on in Syria with the overthrow of that dictatorship and instability in that region. I think, as we've talked about time after time after time, while these events certainly lead to some humanitarian concerns, they don't really lead to much in the way of economic or market concerns. So you may see it dominate the news headlines for the next couple of weeks, but it probably will not dominate the economic or portfolio headlines. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great week, and I look forward to talking to you again soon.